property right here is a great deal, but the bank still says no. Here's why. Hey Broski, welcome back to the channel. A property can look great to me, but if the bank is not happy, it's not happening. Today, I'm learning how banks look at commercial property through two ideas, LVR and DCSR. The bank is basically going to be our business partner. If they are funding 50%, 60% or 70% of the deal, then I need to understand how they see risk. Alright, so the first one is LVR, loan to value ratio. The formula is simple. LVR equal loan value divided by property value. So if a commercial property is worth $1 million and the bank is willing to lend 600,000, we take the formula 600,000 divided by $1 million equals 60%. That means the property has 60% LVR. In New Zealand, the banks are usually more conservative in commercial rather than residential. So usually you see a lower LVR ratio. Instead of 80% for residential, usually for commercial, they want 60% or below. So that basically means if I want to own a building by borrowing money from the bank, I need to front up with more deposit. Okay, so now when I look at $1 million property, I don't just look at the price tag, but maybe the bank will lend me 60%, and so I have to front up with the cash of 400,000. Now, LVR is just one side. Even if they're willing to lend, there's a second part that we need to understand. It's called DSCR, or debt servicing coverage ratio. The formula is simple. NOI, which we've learned in the previous video, divided by total payments. So let's say we have rent at $80,000 and operating expenses 25,000. So our NOI would be that minus that 55,000. For the loan, let's say the bank's happy to actually let's put property value as 1 million, and the bank is willing to lend us 60%, which means it's 600,000, and interest rate, just for argument's sake, call it 7% per annum, and that gives us annual interest costs of 42,000, and our interest coverage would be NOI divided by interest costs, 1.31. Different New Zealand banks will often have different minimums, but you'll often hear something like 1.25, 1.3, or 1.5 as their comfort zone, depending on the risk and type of deal. So now I'm thinking like the bank too. How much would they lend? Does the cash flow comfortably cover the debt? I'm still early in my journey, but that's how we train our thinking. So when the right deal shows up, I'm ready to think like an investor in the bank. If you're on this journey with me, next time you see a commercial listing, don't just look at the price. Ask yourselves how much the bank will lend me to get this property, and will the net income be enough to cover the interest payments? As always, I'll see you in the next video.